How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the Road Options Training Program. And we're going to really quickly get into Market Mondays for 6/14/2021. And to reiterate, if you haven't been here before, really appreciate it. Give me the like, give me a sub. And the reason why we do Market Mondays is we want to kind of bring you a market-based conversation. We don't want to be here a long time. We don't want to spend a lot of time talking about it. And what we want to kind of do is bring you a market-based conversation in a very, very common tongue. Try to kind of sound like the people in your own area, your own neighborhood, and kind of get you to understand the power of the markets and how understanding the markets and leveraging the markets can help you get the life that you desire. And we don't want you to believe that, to be into the markets, you got to kind of be like the guys that's on the screen right now, where you got to have the suits on. You got to be a part of the older crowd, and old is a relative term. You got to be one of the people from CNBC or MSNBC. You got to have a background in finance or economics or either mathematics to really get into the markets. We want you to understand that because there's activities taking place all day around you, every day, 24 hours a day, you don't need any special qualifications outside of a desire to kind of understand how you can utilize the markets to get the life that you desire. So let's go ahead and get into it. So we talked about today, 6/14/2021. The S&P closed the day at 0.18%. It was up. Dow closed down at 0.25. NASDAQ closed the day at 0.74. And we saw the markets kind of, I wouldn't say they were choppy, but they weren't really strong, but they also weren't really weak. They were kind of what I would call almost lukewarm. The 10-year Treasury is at 1.497. We're going to continue to observe that because there's a reason why it continues to go down. And the Federal Open Market Committee will meet on Tuesday and Wednesday of this week, and Powell will speak on Wednesday around 2 p.m. EST. Now, what a lot of people are waiting for is to try to figure out, based on the CPI number that came out last week that was higher than the estimate, will the Federal Reserve or Powell speak about how that maybe that they're going to adjust some of their monetary policy? And that's going to be because so currently right now, we don't have any signs that they're going to start contracting a lot of liquidity that they're adding to the economy. But maybe there's something else that they might do that might maybe affect the market, which will then affect the overall economy. So what people are going to do is kind of wait for Powell to speak on Wednesday to kind of understand where are we going. And then we can kind of frame what we think that maybe the next quarter or maybe to the end of summer is going to look like from a market-based standpoint. And then as we go into the year, if inflation continues to go up, people will start trying to probably move around how they invest their money because of their anticipation that inflation will only go up. Now, the Federal Reserve is telling us that they believe that inflation is going to be transitory, but transitory is a relative term because transitory does not mean 6 weeks or 8 weeks or 12 weeks. So the concept of inflation being transitory is relative. So what may be transitory to them may not be transitory to somebody else. So we got to really understand that. So that's what people are going to be looking out for this week. I don't think it's going to make or break the week, but based on seasonality of the S&P, normally this month, the S&P deals with a sell-off. So what we want to kind of figure out is that is something going to happen this week that may cause a sell-off in the S&P. And then if it does, how what will the amount of the sell-off be? How sustained will it be? So he's coming out on Wednesday, and we may see after Wednesday it sells, or it may not. It may go up, or it may just trade horizontal. We don't know. We got to kind of figure out and play this by ear. So let's get into the jump outs. So we're going to talk about the jump outs is companies that may not have done well today, may have done well or may not have done well, and kind of give you some context around them. So what some people are calling the meme stocks. We talked about before. We're going to get a lot of these quote unquote EV companies are going to come out because that's a really hot market right now. This morning, some information came out. I think they fired somebody or somebody walked off one of the top people in the company. So it caused a big sell off. So they lost 18% over the day, which is big, right? So it opened up, it gapped down. It didn't really fall too much farther down than this gap down, but it did gap down really, really on a very, very big gap down from the open. One of the challenges of buying into these type of companies, they're weak companies. They don't have a track record of success. They haven't really proven themselves in the market. So they're very, very speculative. And you got to understand when you're investing in these companies or you're trading in these companies, you got to understand it's a very volatile situation and they're very sensitive to information because they don't have a track record of success. So therefore, people, to me, overemphasize what they believe to be good, and they also overemphasize what they believe to be negative. Now we'll talk about DoorDash. Now DoorDash, they IPO'd, I want to say early this year, I believe. And, they're one of those delivery type deals. and they did an earnings, and the earnings really to me didn't look that great. But for some reason, they got a lot of really good upgrades on earnings. They hit both their lockout events. A lot of the insiders got out. They cashed out. But for some reason, the stock keeps going up, and they're releasing the fact that they got, partnership deals, yada, yada, yada. To me, a partnership deal in a company that's never going to be profitable doesn't really make a lot of sense to me, or it won't be profitable on a large scale. I don't care what partnership they have, because the question is the partnership lead to profitability? I understand the model of these particular type of companies. Uber, they all have essentially the same business model. The problem is that it only works if they're able to accomplish a certain amount of scale and then also push all their competitors out of the market. If there's a 1 and a 2 in these markets, it really doesn't work. It only can be 1 for the market to actually work, for this model to work. So that's why I'm never enthusiastic about this particular model. However, the stock continues to jump around the 150 to 160. It'll ride back down to maybe 140, 145, and it'll pop back up. And we just need to see how long it can sustain that price, because I don't know who's buying it at these prices. I'm just curious who thinks DoorDash is worth 150 at a share. And I think they might have done 1 earnings or maybe 2, but they haven't even IPO'd out a year. So we're just going to continue to observe this. Now we're going to look at Apple. So Apple was up today around 3%. And some people may say that doesn't seem like a lot, but when you have the amount of float that they have, that's a big movement for Apple. They're around the 130 mark. And the reason why we just put them here is because they're what I call a blue chip stock. They don't get a lot of attention, but they just perform on a regular basis. So if you look at maybe their 5-year outside of COVID, it looks really good. So one of the things is that, a lot of these, what we call meme stocks, get a lot of attention. Apple, to me, is not premium priced like maybe a Tesla or Amazon. However, it just performs really well. And so we just wanted to try to, point that out, that a lot of the really good plays to me in the market, and when I say plays, I don't necessarily mean trading. It could also be long-term investing, are not always the fancy companies. And so that's something I think a lot of people want to look into. If you're looking for long-term stuff, you're looking for things that, over a 90 or 120-day period, from one start to the next start are going to, increase. You're not going to have a lot of really, really volatile spikes. These type of companies are the kind of companies that you may want to consider. Now we're going to talk about a topic of the day. Should you buy the dip? And, I talk about this a lot, but I want to continue to emphasize it, because you have a scenario where, let's say you buy into a company. For whatever reason, it starts to sell off. The narrative that's been put out, a lot of these mainstream marketing platforms, a lot of the mainstream media platforms based around the market, is you should buy the dip. Okay, so it becomes almost like a colloquialism. You should just buy the dip. However, if you don't know personally why you bought into that company, you may want to reconsider buying the dip, because the question is, why are people selling it? So if you bought it and you're not selling it, why is it being sold? And I'm not saying you should be influenced by what other people are doing. The question is, do you know why you bought it in the first place? And what we see a lot from, a lot of this market-based media is that people buy because what somebody else does. The average person, if you ask them that wants to get into the market, or that may already be in the market and may be buying and holding long-term, how do you evaluate a company? What's your process? And many of them will struggle to communicate that to you. And then you say, okay, well, you don't have to tell it to me. Just put it down on a piece of paper. Just explain to me like the steps, the sequence. They would also have an issue doing it, because many of them are getting their valuations from other people. If I'm looking to buy into a company long term, I don't care about any price target an analyst has. I don't care, because I don't believe that they are looking for the same thing inside a company that I'm looking for. So if I don't understand how they analyze companies, and I'm looking to be in a company long term, when I say long term, I mean greater than 5 years. I do understand that if certain investment banks put out a price target, it can influence the share price. I do understand that. But that affects it more short term than it affects it long term. So based on how I will evaluate a company, if I believe that they're a good long term prospect, I don't care what another analyst has to talk about. Right? It just don't, because they also don't care what other analysts have to say. So you will see a market-based show. They'll have 2 analysts on there with 2 conflicting views. Well, how come the first one doesn't care about what the other one says and the second one doesn't care about what the first one? So then my question is, why do you care so much about what they mean? So the question you want to start asking yourself is that if you're looking to buy and hold long term, first, do you have your own way to value a company? How do you create a value around a company? What's your process? Then if you have a process, why do you care what other analysts do? Because they don't care what you do. So do you believe that they have some insider information, or they maybe have some insider knowledge to where they're able to now come up with a price target, and their price target is probably closer to where the share price is going to end up at the end of your time horizon? So do you know why you bought in the first place is the question I'm going to ask you. And if you did buy, did you buy based on your valuation or buy based on somebody else? And what many people will do is they will hand off the responsibility of these things to somebody else, because in their attitude, I can go focus on something else. But I would tell you, when you are investing your money in a company, I would encourage you to really do your due diligence. Because if you're going to be in a company long term, you don't have to worry about the price running away from you, because you're going to keep accumulating anyway. So if you're going to be in a company long term, you don't have to get in right now. You can get in 90 days from now, because you're going to be in the company long term. You're going to continue to accumulate, so you don't really trip on the price being up 5% down. It doesn't matter at that moment. So you're not worried about the thing running from you. Okay. There was a guy, y'all might know him. Some of y'all might not know him. And I don't know the guy personally, but he used to have a big YouTube page. And I mean, I will admit, this guy actually had a process in which he looked at companies. Like, he actually had a process. And I think he might still be in the Fed right now. Who knows? But he had a YouTube video, and I had watched his YouTube video at one time. This is like 3-4 years ago. And he said, you shouldn't put $1 into a company till you've done 100 hours of research on the company. You shouldn't even put $1 into it. You know, and that's his personal perspective. Don't mean they got to be yours. But he was a person who had worked, I believe he one time had worked for a fund or worked for a particular bank. And they kind of put into his head the level of due diligence he should have before he even put $1 into a particular scenario. And so that's what I want people to understand, is that a lot of times people are buying the dip and they don't know why they bought it in the first place. Because let me explain something to you. If something is at its 52-week high, goes to a 52-week high, and then it sells off from its 52-week high, it doesn't mean that it's on sale. Doesn't mean that. And the reason why it doesn't mean that is because, well, what is the value of the company to you in the first place? So let me give an example. If they try to tell me that this car is worth $250,000, and I don't believe any car is worth $250,000. Well, now if the car is priced at $180,000, it doesn't mean that the car is on sale now. It just means I still don't believe that a car is worth $180,000, because I don't believe any car is worth $180,000. So just because the price has come down, its value to me has not changed. So what a lot of people get indoctrinated into believing is that, well, the value is here and it's at its 52-week price high, and I value being in this deal so much that when the price drops, I'm made to believe, well, the market is on sale. The question I want to ask you, if a car costs $225 and you don't believe that car is valued at $225, you don't believe the value of a car is $250,000, and the car now is priced at $180,000, do you believe that it's a sale now? So these are the kind of questions that nobody asks on these platforms, because it's about them being right and everybody just getting their right information. It's not about me being right. I'm wrong about a lot of stuff. You know, people make mistakes every day, myself included. So the question is, if you got into a deal, why did you get into that particular deal at the first place? How did you determine the value of it? So what is the value to you? Is the value tangible or is the value emotional? A lot of people get into deals and there is no tangible value. It's all emotional, like the Tulsa real estate fund. There is no, if you actually understood the documentation, there was not a lot of tangible value from a monetary standpoint. It was emotional. There's nothing wrong with that. Some people want to be into something because it makes them feel good. And that to me is probably more powerful than the tangible value. right? The act of feeling good because I'm in something. That's more powerful probably than actually getting an actual monetary return. So why are you in a particular deal? Is there actual tangible value that you can get from it, or a tangible result, or is it just all emotional, right? And then you can start to determine, what value from a number standpoint do you put on this? Sometimes people say, well, you can separate price and value. I don't believe that, because to me it's emotional. So all buying behavior is emotional. All buying behavior is emotional. So you can't separate and have this logical price, but make the value emotional and think that they're not going to override each other. At the end of the day, all buying behavior is emotional. So a person will override any kind of logical statement to buy something. So what we understand when we study sales is that people buy something for an emotional reason, and then they turn around and rationalize it in their mind why they bought it. But the reason why they purchased it in the first place was emotional. So 100% emotional. So there's no logical way to buy something. All buying behavior is based on emotion. So the same thing when you go into the stock market, you're buying a share of stock. That's an emotional reason why you did it. Okay. Now you turn around and logically say, well, you know what? I think I can get a 7% return per share, or I can get a 15% return. So now I'm going to logically rationalize why I made a purchase decision, that the purchase decision was emotional. So it's very difficult, in my opinion, right, to separate value and price. To me, it's all an emotional based decision. And to me, they pretty much sit on top of each other, where value and price are perceived really to the consumer as the same thing. And when you go into the stock market and you're buying stocks, you are a consumer. You're not, even though you're acting as an investor, you're still a consumer. You're a consumer of that particular stock. So what I want you to understand is that when you're buying the dip, why did you buy in the first place? If the thing starts to sell off, the share price starts to fall, why do you think buying it at a lower price is a good deal? Just ask yourself. And if it's emotional, just say, yeah, it's just emotional. I just think this is a good company to be in. I don't have any type of metric-based valuation. I looked at discounted cash flows, or I looked at, how much cash the actual company has in relationship to the debt, or I looked at the return on assets and return on equity, or, I maybe looked at their management team, or I maybe looked at their quarterly revenue over the past, year and a half, or I listened to their earnings call and I kind of really believe in where the company's going into the future. I think, from an emerging market standpoint, they're positioned really well. I don't care about any of that. It's just emotion. I'm a fan of the CEO. I like their Twitter page. Or I want to feel like I'm part of this new movement of technology, so I buy that. Or I want to feel smart, so I just try to buy a bunch of tech so I can feel smart, because I emotionally connect tech to being smart, right? Or what I believe tech to being smart. Because like I say, you don't even own a gun, but you're a tech person. So that's the thing. So just try to figure that out. So then when it starts to sell off, the reason why you're deciding to accumulate more as opposed to selling, right, as it goes down, or as opposed to just sitting back and saying, well, you know what, let me see where the price goes before I start to accumulate more. Because, we can have a whole nother discussion how a lot of the big funds, they push it up with PR to create demand. They didn't buy at the top. They bought at the middle or the bottom. They push it up. They sell the top. Right? They sell the top, push it back down, and do the process all over again. They make money going up and going down. But that's a whole nother conversation. So that's going to pretty much be the topic for Buy the Dip. Hope you got value from it. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. Talk to you later.